has kicked off on Wall Street. The major stock averages did see a strong surge at the open, but in midday trade, the averages have pair gains. Joining me without further ado is Peter Cardillo of First Standard Financial. Peter, Happy New Year and thanks for joining me.
Happy New Year to you.
Well, first and foremost, we're kicking off the new year with quite a gain in equities as well as crude oil prices. We're once again seeing the dollar rally. So heading into the new year, what are you watching?
Well, it's a good kickoff to the new year. And, of course, we're halfway through the sessions and the indices are basically holding up on the plus side. I think there are several factors for this. One, there were some markets in Europe yesterday that were actually open, and they managed to close on the plus side. So they began the new year in the green. And, of course, today we had a follow-through of that. And I think the fact that we had very strong oil prices this morning and the fact that the economic news was really good basically is behind this rally. And of course, we ended the year basically on a flat note, but near the higher end of the trading range. And I think most of that was due to just last minute profit taking or basically locking in losses. So now we start a new year. And, of course, everything is going to be based on the economy's performance.
And, Peter, with this new year comes a new presidential administration. We have 17 days left until the inauguration. And down in D.C., the Congress has, the 115th Congress has kicked off. Now, there are a lot of expectations in play. But in terms of event risk, we do have the jobs report at the end of this week, and we have corporate earnings. So what are your expectations?
Well, I think the economy right now is on a roll in a sense that is expanding. Most of the economic data that we got certainly supports that. We saw that with the factory activity today. And even the news out of China was good in terms of factory activity. Well, I'm looking for non-farms to gain by 180,000. With the unemployment rate sticking at 4.6%, which, by the way, basically indicates that the U.S. economy is now in full employment.
And Peter, last but not least, before I let you go, I do want to shift our focus on over to the eurozone. Now, over the weekend, we did get comments out from a German economist with the IFO Institute regarding Italy's status with the eurozone. But do you lend any credence to those comments?
Well, there's always negative and positive comments coming out, especially some of the nations that are struggling, especially in the banking system. And, of course, Italy is one of them. But I kind of think the major crises for the banking system in Europe is probably going to linger, but I don't see it getting any worse. And in terms of the euro, I think we're probably headed to parity or perhaps slightly lower than parity. And, of course, if you measure that by the dollar index, which today is soaring, making actually actually at a new high and surpassing last year's 52-week high. So that's, a good indication that the euro is going to get weaker. And that's not necessarily all that bad for Europe, because that probably will mean that they'll be able to pick up their exports, and that will add to their gross domestic product.
Well, Peter, thank you so much for joining me at the beginning of the year, and I wish you a happy and healthy start to 2017.
Same to you.